Welcome to our channel Fiscal Academy. Factoring is a form of financing in which a seller can sell its receivables to another party, which can be called the factor. The factor could be a bank. Factoring is helpful if the trade agreement has usance payment, which means the buyer will pay later. If the seller is cash strained and cannot cover his short-term debt obligation from the sales proceeds, they can opt to sell their outstanding invoice to the factor. It is like selling your receivables to another party. This helps inject some cash back into the business. The factor will purchase the receivable, but at a discount and some fee. By the time value of money, the money worth tomorrow will be less than it is worth today. So, the factor discounts the invoice and charges a fee that depends on the number of days until the receivables maturity date. For example, the fee for a receivable that is expected 90 days from today will be less than the one that is expected 120 days. The bank then informs the buyer about the arrangement. In factoring, the risk of default is transferred to the factor, i.e., bank. Therefore, the fee could be higher for cases where the probability of default is higher. To mitigate this risk, the bank acquires credit reports on the buyers to check their creditworthiness. It helps them decide whether they want to take the exposure on that party or not, and if yes, then at what fee. The seller's benefit is that they have access to cash early, and they don't have to wait for the receivables to mature, nor do they have to worry about the default of the buyer. Factor's benefit is that as banks, they will settle their books with full invoice value once the amount arrives. There are other sources of earnings as well, for example, service fees, exchange earnings. Invoice discounting is like invoice factoring, but with the difference that it is a loan by the bank against unpaid invoices. So the bank doesn't buy the seller's invoices, but rather disperses a loan in their account against those invoices. The factor can ask the seller to sign an indemnity at the time of discounting that, in case the buyer defaults, the seller will be responsible for the repatriation of the full invoice amount. In case the buyer doesn't pay on time, the bank charges an overdue markup on the seller. The bank doesn't inform the buyer about this arrangement, since the risk of default is with the seller and it is a loan. Once the payment arrives, the seller repays the loan outstanding, along with an agreed-upon fee and interest. This way, the seller gets access to instant finance at a cheaper rate, since the risk has not been transferred to the factor, and it's also suitable if the seller isn't interested in the buyer knowing about the financing. An exporter A sells denim jackets worth $200,000 to a company B in the US on usance. The payment will be received 90 days from the day of shipment. Seller A requires urgent financing to cover their short-term requirements and can't wait for 90 days. Therefore, they approach a factor, Bank C, for factoring. Bank C purchases the receivable at a discount, charging a service fee to A, and gives the money to A immediately, and also informs B about the arrangement. These receivables are now receivables on the balance sheet of the Bank C. After 90 days, when B pays for the invoice, Bank C will settle its books. If it was a case of discounting, then Bank C disperses a loan to Company A of $180,000 and makes them sign an indemnity that in case of default, they will be responsible for the repatriation of funds from the US Company B. In case of delay, Company A will have to pay an overdue markup as well. After 90 days, when the payment arrives, Company A pays back its loan to Bank C, and the bank deducts the fee and interest. For more explainers, hit like and subscribe.